On January 20th, 2026, Japan's 30-year government bond yields reached 3.9%, a level not seen since these securities were created in the 1990s, and within 48 hours, the US Federal Reserve intervened directly in foreign exchange markets to stabilize the Japanese yen. That intervention wasn't routine coordination. It was an emergency response to prevent financial contagion from spreading across the Pacific. And if you're holding US stocks, bonds, or real estate, what's unfolding in Tokyo right now is about to reshape your portfolio. If you want to understand how Japan's debt crisis is creating a forced liquidation cycle that could move trillions of dollars out of US assets over the next 12 months, subscribe to The Econaut, because we track the structural forces moving global capital before they become front-page news. Japan carries debt worth 250% of its annual economic output, making it the most indebted major economy on the planet. And for 3 decades, that debt remained manageable because Japan maintained interest rates near zero, while Japanese investors sought returns elsewhere. But in December 2025, the Bank of Japan raised its policy rate to 0.75%, the highest in 30 years, and simultaneously abandoned yield curve control, the policy framework where they artificially suppressed long-term rates by purchasing unlimited quantities of government bonds. The market response has been severe, with Japan's 10-year government bond yield climbing from 0.5% to above 2% in under 6 months, while the 30-year yield reached 3.9%, a move so rapid that bond traders classify it as a Six Sigma event. This isn't just Japanese financial news that stays contained in Tokyo, it's creating mechanical pressure on US asset prices through a mechanism most investors don't fully understand, called the carry trade. Japan holds approximately $1.2 trillion in US Treasury securities, making them the single largest foreign holder of American government debt, more than China, more than any European nation, more than all Middle Eastern sovereign wealth funds combined. That accumulation was the result of what became the most profitable leveraged trade in modern financial history, executed continuously for 3 decades by Japanese banks, insurance companies, pension funds, and individual investors with elegantly simple mechanics. Borrow yen at 0% interest, convert to dollars, purchase US Treasury bonds yielding 4% to 5%, and collect the spread with minimal risk. For 30 years, this trade generated consistent returns, and hedge funds worldwide leveraged the strategy 10x, 20x, sometimes higher, to amplify returns from 4% annually to 40% or more. Major bank estimates suggest the leveraged carry trade involved between $15 and $20 trillion in notional exposure globally. But the fundamental math just broke, because Japanese government bonds now yield between 2% and 3.9% depending on maturity, meaning a Japanese investor can achieve substantial returns in their home currency without foreign exchange risk. The question becomes obvious. Why would a rational Japanese institution convert yen to dollars to buy US treasuries yielding 4.8% when they can purchase Japanese government bonds at home yielding 3.7% with zero currency risk? The risk-adjusted return no longer justifies the trade, which means those positions will unwind as Japanese institutions repatriate capital, creating forced selling pressure on US Treasury bonds potentially exceeding $1 trillion over the next 12 to 24 months. We've already seen a preview. In August 2024, when the Bank of Japan surprised markets with an unexpected rate increase, Bitcoin fell 23% in 3 days. The Nasdaq dropped 10%, the S&P 500 declined 8%. That was a tremor caused by a small policy shift. What's happening now is structurally larger, more sustained, and significantly harder to reverse because Japanese rates are rising from fundamental policy repositioning rather than surprise announcements. The impact extends far beyond treasury bonds because when leverage positions unwind, the selling isn't surgical, it's indiscriminate, with hedge funds receiving margin calls selling whatever trades most liquid to raise cash immediately. This means US equities get sold not because companies are underperforming, but because institutional desks need dollars to close underwater positions. Real estate markets face pressure through mortgage rates tracking long-term bond yields. So if Japanese selling pushes the US 10-year Treasury yield from 4.8% toward 5.5% or 6%, 30-year fixed mortgage rates currently around 7% climb toward 8% or 9%. Cryptocurrency markets become early casualties because when institutional capital is forced to reduce risk exposure, Bitcoin and Ethereum represent among the most volatile, least essential holdings. We witnessed this in August when Bitcoin dropped 23% in days. According to Bank of America's latest survey, approximately half of institutional money managers currently hold zero downside protection in their portfolios. No puts, no tail risk hedges, no defensive positioning, meaning they're fully exposed to market declines. When everyone attempts to exit simultaneously, market microstructure breaks down. But Japan isn't the only source of potential treasury selling pressure, as European governments and institutions collectively hold approximately $3 trillion in US Treasury bonds, triple Japan's holdings, and European nations face intense political pressure to increase defense spending. Where does that additional defense spending come from when most European governments already run fiscal deficits? Asset sales represent the most politically feasible option, with US Treasury bonds constituting one of the largest, most liquid asset classes available on European institutional balance sheets. The US Treasury Secretary's response, revealed at Davos, consisted primarily of expressing confidence that Japanese authorities would begin saying things that will calm markets down. And when the Treasury Secretary relies on hoping foreign officials will make reassuring statements, it suggests the available policy toolkit is limited. This creates a phenomenon called correlation breakdown, where traditional portfolio theory suggesting that when stocks decline, bonds appreciate, the classic 60-40 portfolio's negative correlation, inverts when government bond issuer creditworthiness itself becomes questioned. We observed this in the United Kingdom during September 2022, when Liz Truss's government nearly collapsed the gilt market. British stocks and government bonds both fell in tandem. British pension funds faced insolvency. Ken Griffin, founder of Citadel, recently warned that bonds lose what makes them special in a portfolio when bonds and stocks move together in prices, which translates to your diversification hedge is gone. Your 60-40 portfolio now functions like 100% equity exposure. First, understand your current exposure by examining exactly what you own. If you're heavily concentrated in equities and fixed income with minimal hard asset allocation, you're structurally vulnerable to what's unfolding. Second, monitor specific indicators that signal acceleration. US 10-year Treasury yield sustaining above 4.75% indicates foreign selling overwhelming domestic demand. 30-year Treasury yields breaking above 5% signals long-term rate stability breaking down. The dollar-yen exchange rate dropping rapidly below 140 means carry trades unwinding at velocity. Third, consider defensive sector positioning to preserve capital during sustained volatility. Energy companies like ExxonMobil and Chevron maintain essential demand and generate substantial cash flow. Gold and silver accessed through GLD and SLV historically retain value when government debt sustainability comes into question. High-quality technology companies possess fortress balance sheets and massive free cash flow, and consumer staples benefit from inelastic demand. What to reduce or avoid? Regional banks holding large unrealized losses on bond portfolios face existential risk if rates spike further. High-debt companies approaching refinancing deadlines will pay dramatically higher interest costs. Consumer discretionary and luxury goods see demand evaporate when economic uncertainty rises, and speculative, unprofitable technology companies burning cash get eliminated when risk appetite disappears. Fourth, consider allocating between 10% and 20% of portfolio value to hard assets that aren't liabilities of any government or institution. Physical gold, physical silver, and potentially Bitcoin for those who understand its volatility. These assets move independently of government bond markets when traditional correlations break. Fifth, avoid the cash trap that conservative investors default toward during uncertainty, because cash gets destroyed by inflation. And if the Federal Reserve responds by restarting quantitative easing, cash loses purchasing power rapidly. Cash provides short-term liquidity, but isn't a long-term safe haven when central banks may resort to monetary expansion. Japan's carry trade economics no longer function at current interest rate differentials, meaning positions will unwind whether through orderly repositioning or forced liquidation. Japanese investors hold 1.2 trillion in US treasuries that become less attractive daily. Hedge funds maintain 15 to 20 trillion in leveraged exposure that must be reduced, and European institutions may accelerate sales to fund defense spending. Your portfolio faces exposure to these dynamics regardless of whether you followed the carry trade or even knew it existed, because when trillions in leveraged capital unwind across global markets, correlations break down and assets get sold indiscriminately. The only variable is whether you recognize these dynamics early and adjust positioning proactively, or whether you maintain current allocation assuming traditional portfolio theory still applies and discover after significant losses that the rules changed. If this analysis helped clarify why Japanese interest rates matter for your US-based portfolio, subscribe to the Econaut and enable notifications, because the next video examines specific timeline probabilities and exact trigger points. The math doesn't care about hope. It just executes, and right now, the math says leverage positions are unwinding at scale, which means markets will experience volatility until that process completes. Your portfolio positioning determines whether you preserve capital or watch it erode during that transition.